Hey everybody, Josh Sigurdson, World Alternative Media here, and of course we're joined by author and economic analyst here at WAM, John Sneisen, and we have been going into the housing markets around the world for quite some time. We've seen a lot of similarities to that which happened in 2007, especially over the last year. It's alarming to a lot of people because it affects a lot of people, and the last thing we need is to lose everything we have and end up in poverty, which is a big reason why we do these videos to help educate people. But as this article from Seeking Alpha says, recent Blackstone deal confirms that the market is rigged. And as it goes into, Blackstone's credit default swap had an engineered default. The CFTC leaned on Blackstone to unwind its CDS. Deals like this undermine investor confidence. And as the actual article talks about here, a recent questionable deal by the Wall Street behemoth Blackstone has shaken investor confidence in the markets. For months now, the Wall Street Journal has been reporting on a shady deal between Blackstone and Hovnanian Enterprises. One of the largest asset managers in the world, Blackstone offered Hovnanian a low-cost loan and persuaded the builder to miss a small interest payment in exchange, which would trigger payouts on $333 million in Blackstone's credit insurance contracts and yield the firm tens of millions of dollars depending on market factors, according to one article. The insurance contracts Blackstone took out, known as credit default swaps, typically pay out when a company defaults, usually reflecting dire financial straits, the journal reported. But Hovnanian was healthy enough to pay its debts, so a default would be opportunistic. Such financial manipulation is why some investors remain fearful of the stock market despite its historic 10-year bull run. Who can investors trust when Wall Street fosters such clearly unethical behavior? Solus Alternative Management, the fund which stood to take a loss if derivative contracts held by Blackstone were tripped, sued to put a hold on the deal. A judge in January ruled in favor of Blackstone and allowed the transaction to go through. Banks, hedge funds, and International Swaps and Derivatives Association industry group also voiced concern about Blackstone's strategy, according to the journal report. Even the regulators got involved. The Commodities Future Trading Commission, the CFTC, waged an unusual campaign to get Blackstone to unwind its bet on the credit default swap, according to the journal. Regulators typically wait for Wall Street to create a mess before jumping into action, so it's notable that the CFTC took early action in the Blackstone matter. If Blackstone could create so-called engineered defaults, the strategy could have proliferated and distorted the entire credit default swap market. While the CFTC encouraged the parties to work out a solution, even Blackstone realized they had to make this issue go away for the integrity of the markets. The various parties confidentially settled the matter about a month ago, just before it blew up in their faces. As with insider trading, every time investors see what looks like a rigged market, investor confidence diminishes. Thankfully, the CFTC stepped in. Clearly, regulators need to be more proactive to prevent this type of thing from happening again. Investors are counting on it. And anyway, so it always jumps to, well, these guys are terrible, these big monopolies that have been propped up by government, manipulating markets, all that kind of crazy stuff, the usual, kind of stuff. And then they say, well, maybe the government can come in and save them, the CFTC to the rescue. And it gets to the point where it just goes around in circles forever, folks. And John, I want you to go into what this really means, what this is a sign of, what people should be concerned about with this Blackstone case.
Well, it's a sign of there's no ethics on Wall Street. They don't really give a crap.
No one's surprised.
No, yeah. What they want is just to make as much money as they can, and they're just trying to find opportunities and ways to engineer the markets to make substantial amount of money. $333 million is not a little bit of money. We're talking about a substantial amount of money. And of course, it's a fantastic way to use it. I think they should have taken it to another level, though. I'm kind of disappointed that they didn't go further and did what they did in 2007-8, where they had mass amounts of people betting on those credit default swaps instead of just Blackstone. That kind of makes it lame. We need a big scandal that we can talk about here at WAM, and I think we should back a couple of I think it was a couple of months ago, me and Josh were talking about about Wells Fargo and how I propose to become the CEO of Wells Fargo, and then we're gonna put in credit default swaps on their building, and then we're gonna burn it down. And I'm gonna have all the banksters come in on it, and then everybody could make money on the failure of a bank. It'd be fantastic.
Of course, the lawyer trolls that are watching were saying this in jest, but I think it's really important to mention that obviously it would be good for all of us if they just heated up to the point where they exploded, so we could start from scratch, because they've been putting off the inevitable for so long, propping up a dead horse, making it so fat and heavy that when it falls over on us eventually, which it inevitably has to do, it'll crush us all underneath. And it's more important, the sooner the better, rather than propping it up, centralizing more, manipulating more, pushing it off for later, and then having to deal with an even bigger issue. But the housing market is in a huge bubble in many places in the United States and Canada right now, in Britain, in all over the world, Australia,
New Zealand,
Norway, I mean everywhere. So what does this mean for the market when you see these guys doing this, and it seems almost desperate?
Oh yeah, I think that's what it is. They're getting really desperate on finding any yield or any money. Like what you gotta understand is we've been so financialized, and I think we're starting to see closer and closer to what I call debt saturation, but you could also call it financial saturation of the markets, where it's been so financialized that there's no real market left in the economy, and they just use all these different derivatives to manipulate and basically suck out capital out of the markets, real money out of the markets. Meanwhile, those derivatives in the first place, like 333 million, that derivative didn't really exist until that defaulted. So that was money that really existed. It was just created really out of thin air when that default came. And that's why you saw AIG in 2007-8 failing, because so many people had used these bets. And it's interesting how they actually called it insurance in this article, which is, it really is. And that's, talking about the regulators, that's actually how they got around the regulator, Blythe Masters, back in the day when she created it. It's really interesting to see just the bankers and the regulators. Basically what it is, it's just the banks are paying off the regulators just to make them do whatever they want, because the money that they make on these deals are way less what they pay in fines.
Yeah, of course, we're seeing the return of the collateralized debt obligations as well. We saw that with BMO, I believe, and a few other huge banks that we're seeing the repeat of that from 2007. And it's interesting, of course, collateralized debt obligations are, you put together, let's say you have 100 mortgages, 95 of them are terrible, and then 5 of them are decent, and you package that together and then rate it all as AAA by the top few, which is totally insane. But we are seeing the return of a lot of the things that we saw in 2007, which means we need to be proactive and careful, and especially not looking at houses as an asset, etc. There are huge bubbles everywhere, and people just have this investor confidence, glassy-eyed euphoria that everything's going to go up forever. But John, let's go into derivatives a bit, because we are looking at, what is it, 1 quadrillion, 100 quadrillion? There's more money in derivatives than there is in the entire world right now.
Yeah, well, it depends. There's so many different calculations. I was listening to Edward von Greyers of Matterhorn Asset Management just recently at Greg Hunter, to give them kudos there. He was talking, he thinks about 1.5 quadrillion of derivatives, slushing around the world. Now, I want to not just talk about the derivatives here. I want to talk about all the bank manipulation, Josh, that's going on, which is substantial around the world. Let's just mention a couple here. Let's mention of course, the rigging of the gold market and the silver market, rigging of oil markets by the OPEC. You talk about rigging of all these different markets around the world where,
Let's not forget cryptocurrency. And also, just to make a point on what you said about the gold markets, we have evidence right in front of us. Deutsche Bank was found guilty in a court of rigging the gold and silver markets in 2016. And on top of that, they were caught alongside a whole bunch of other guys, but they took the fall. And remember, this is the same bank that is looking at laying off 10,000 employees, 1 in 10 of their employees. They were just downgraded from from A- to triple B plus. And that, I mean, that's a huge issue. That was by the S&P, of course. And all the banks are insolvent, looking at the cash to deposit ratio, which you've looked into. I mean, this is just a calamity waiting to happen.
Oh yeah, it totally is. And not to forget, I was going to talk about some other manipulation that they did, and this all the way back from 2008. Their leveraged buyouts that HBOS and RBS did in Scotland. Which was a substantial amount of scam where to just basically strip down companies and take all their assets and then just bankrupt them. It's just ridiculous what these bankers are doing around the world. And with these derivatives, different derivatives, not all derivatives are horrible and terrible. There's a couple of few that might be a little bit good, because futures, selling cattle and things like that is not that easy. Without it, it's easier to, but of course you need it on something that could be accountable. And of course the bankers are, printing contracts out of thin air with the COMEX, and who knows with all the other different contracts they have on other commodities, how much they manipulated them. Like, you got to remember, like JP Morgan has tried to corner different commodities markets. And I think it was Blythe Masters actually talking more about her that was, involved in, rigging and controlling these markets and trying to, make it so it looks like, there's no problem. Gold and silver is not doing too well. Like, they're just down in the gutter. Let's just forget about them. And then when they, finally extracted all the money that they need from the markets, they just let it fall. And of course, the idiots are coming in and buying up everything right before that happens. Because they told them to. They told them that, it's so fantastic, the markets, everything is going really good. And then suddenly it just turns around and it get eviscerated. Now, of course, with all these derivatives, the different ones, like the credit default swap is the worst one in my point of view. But look at the collateralized loan obligations on all the corporate debt that's out there. That's, in my point of view, one of the dangerous ones that's coming forth. And a minor one too is the auto-backed securities that are coming out with all the auto loans that have been tranched together. So there's a lot of these dangerous derivatives.
Don't forget about auto-backed securities in the Carmageddon apocalypse that we're seeing play out in front of us as well. I mean, there's derivatives on everything. And actually, you mentioned something earlier that made me think about I'm a huge fan of a guy named Edward Stringham. And now Edward Stringham wrote the book Private Governance. Incredible book talking about private governance, of course, as the title says. But he is a fan of derivatives. And I've been wanting to get together a little debate for a little while. I'm going to have to reach out to him, because that would be interesting to see you talk with him about derivatives a bit, because he writes in his book, one part of the book I didn't really agree with. He's like, well, derivatives didn't lead to the bubble in 2007. Derivatives are great. Well, it
depends on what kind of derivatives he's talking about. He's talking about options or puts. That's a totally different type of derivatives. But what it is, though, options and puts is just another financial layer on top of the, already derived. You can remember stocks are even a derivative, Josh. It's not really like a real thing. It's just shares in the company. You're not running the company. You're not owning it. You can't have any control over it. It's just gotta, run on the decisions of the CEOs and the people involved in the business.
There's nothing intrinsically wrong with, for example, stocks. It's just the fact that they're so caught up in vast centralization and manipulation, and they overconfidence in something that in most cases don't have the fundamental value that you'd expect it to have. A great example is the market euphoria for the stock market right now in the United States, or at the Toronto Stock Exchange as well. We see a lot of investor confidence, but it reminds me of any bubble of the past. There are some good things mixed in there, but then there's overwhelmingly a whole bunch of bad things that don't have the fundamental value that's being rushed into that market, and it causes a bubble, and then the bubble bursts, and you see too much investor confidence but not enough fundamental value. We see that in cryptocurrencies as well, and I'm a big fan of cryptocurrencies that are decentralized, but you look at hundreds and hundreds, if not thousands, of cryptocurrencies, and a few of them are amazing, incredible, world-changing, earth-shattering. However, then you have so many terrible ones, and then it bubbles up the market, and then all of them suffer the consequences, which is what we saw happen between December and recently. So, I mean, it depends on what exactly you're getting involved in. If there's a stock for a great company, that's not necessarily a bad thing. It's just a fact that it's mixed in with terrible, terrible manipulated markets that are completely centralized.
Well, one solution that would be actually investing privately in stocks instead of public stocks, because because all public stocks, when shit hits the fan, you really are getting destroyed having other stocks that might not have been that bad because everybody's just trying to exit out of their assets and trying to cover the losses, and so everything just sells off and goes into the crapper. Now I'll talk quickly about, you were talking about the derivatives. Well, and you know how derivatives didn't cost anything in 2008. Well, problem was that mortgages are derivatives over home loans from banks, right? And then they were then packaged into a special purpose entity, which is another derivative, and then they were pushed into another unit, which was called the collateralized debt obligation, which all these little special purpose entities with hundreds of mortgages were tranched into. That's a third derivative. And then you have the fourth derivative, that was the bet, the credit default swap on top of, you know, betting against the failure of the triple derivative there. So like you're looking at almost 4 layers of derivatives there when you really think about it, and it just shows you that derivatives definitely, you know, caused the 2008 crisis. It's just stupid not to think that it or say that it would. It's just insane.
And it's also, on top of that, you have a whole bunch of huge monopolized corporations that are propped up by government regulations and taxes where, you know, they can afford to deal with the taxes, they can afford to deal with the regulations, but the small businesses cannot. And the small businesses get pushed out of the market because of it, and then you see these companies get propped up by government. So that's a huge side of it too, because then how do you compete in that market? You just have everyone rushing to a few certain entities, and there isn't competition, innovation, productivity, isn't more employment, etc. And it's a huge problem, and wages are lower because of, well, not because government isn't involved. Wages are lower because they have no incentive to pay their employees good, because there's no competition in the markets. You just have these giant monopolies.
Well, look at I'm going to just do one more example. For example, take a look at what's happening in the stock markets. Why they're rising? Well, it's because of share buybacks. So share buybacks uses a derivative called money out of thin air from the bank, borrowing it. And then what they do is they go out and then, buy back their own stocks. And then the debt that was created, that is getting tranched into these collateralized loan obligations. First they get put into special purpose entities to get it off the bank's books, because that's how they do it, guys. Listen to me, we're covering, how Cyprus, how they hid basically the Cypriot cooperative bank. They created a special purpose entity for all the bad debt and hid it there. And then now the bank looks really good, and now they could sell it off. This is what they do. They just create all this, accounting manipulation. They literally have financially engineered the whole world, and what they're doing is just continuing to do it and just continuing to destroy the world around them. And at one point, I really hope that the populace will, I don't know why people haven't stood up before and said and called BS on all these guys, constantly defrauding them. But then they were like, well, listen, we got to have the regulators are there for us. They got everything under control. And as they said, the regulators actually came in and, did something there. Usually they just sit there and then they just wait for something to happen, and then it's like, oh yeah, now we got to do something. I think if you make a stupid investment, you should lose that money and learn from it.
That's individual responsibility, right?
And there's no need for all this deposit insurance. Actually, talk about deposit insurance. Another scam. Here in Canada, 0.39% of all the deposits under 100,000 is covered. So it's just totally insane. All these scams that are out there that are supposed to protect the consumer. Meanwhile, they're just out there to just make things look a lot better than they really are.
Yeah, and with the ECB in Europe, Mario Draghi has spoken a few times about just doing away with the depositor insurance altogether.
It'd be better.
Yeah.
Do it.
Yeah, exactly. But anyway, I did want to mention as we wrap it up that this is all coming down to the fact that the fundamentals are off the table due to the level of manipulation in the markets. So yeah, exactly. So you cannot put a date on the crash. You just know what's going to happen. It's inevitable, and there are so many telltale signs, folks, which is why it comes down to you as an individual educating yourself, understanding these things, understanding money, so that you have control of your money and your money doesn't have control over you, and you are self-sustainable, financially responsible, and again, food, water, shelter, self-defense. You're not gathering things for the toughest guy on the block. Gold and silver, in my opinion, not investment advice. It's in the end wealth insurance advice. Anyway. Yeah, it's wealth insurance anyway. It's protecting your purchasing power. So it's not even an investment. And then, of course, cryptocurrencies as well that have sound fundamental values. Make sure to do your own due diligence on that and everything else that comes your way in this world, because nothing is as it seems, folks. And it comes down to you understanding that and sidestepping it and doing everything you can to protect yourself and your family and spreading that education on to your friends. So thanks for going into this with us, John, and we will be back with more here at WAM. This is Josh Sigurdson and John Sneisen signing out from World Alternative Media. Find the truth, be the change. Like what you see here at WAM? Don't forget to check the links below. GoFundMe, Patreon. We can't do it without you. Any donation is very much appreciated, especially as we are so overwhelmingly demonetized by YouTube as they bring in the ADL to flag all of our content as hate speech. Also check our Bitcoin address in the description as well as on the screen for you to scan if you please. And also check us out at Steemit at Josh Sigurdson, the future of social media, where you get paid in the upvote of your post in cryptocurrency, Steem that is. So don't forget to check us out there and find us at Anarchapulco 2019. I know it's early, but this is such an exciting event coming up with Ron Paul, Judge Napolitano, David Icke, Larkin Rose, Jeff Berwick, all the usual characters, and it's going to be amazing. So we hope to see you there. Make sure to check the link for Anarchapulco below and use promo code WAM to save as much as 15% on your tickets. We hope to see you there. But until next time, this is Josh Sigurdson signing out from World Alternative Media. Find the truth, be the change.
Thank you.